Thank you for joining us at XM.com. This is the Market Comment for Thursday, October 19th by Ref Boyajian. I'm Cristina Marujas. Stock markets fell deeper into the red on Thursday after widespread losses yesterday on the back of the tense mood in the Middle East that has fanned the rally in crude oil, which in turn is pushing up soaring bond yields even higher. The ongoing risk of an escalation of the conflict that could draw in other regional powers, such as oil-rich Iran, drove oil futures up more than 3% at one point. Both WTI and Brent crude futures later erased some of those gains to close around 1.8% higher, but gold maintained a sturdier uptrend. The precious metal has jumped more than 6% since the outbreak of violence in Israel on October 7th, and it is trading higher today to test the $1,950 an ounce zone. Demand for safe havens failed to put a cap on bond yields, and the recent run of solid economic indicators out of the United States has added fuel to the rally in Treasury yields. The yield on 10-year Treasury notes reached a fresh 16-year high of 4.98% today. Fed officials have been questioning the need for additional rate hikes lately, but after the hat trick of recent data, investors have begun to price in a higher probability of one final 25 basis points rate hike. All eyes today will be on the Fed chair, as Powell will be speaking at the Economic Club of New York before the blackout period begins at the weekend. Stock markets took a fright from the relentless upward march in bond yields, with all three of Wall Street's leading indices closing lower on Wednesday on the back of disappointing earnings. Even if the Fed decides against raising rates further, the higher-for-longer reality is slowly sinking in for investors, with 2024 rate cut expectations pared back sharply this week. However, Netflix could spread some joy today as its stock surged by more than 10% in after-hours trading when it reported impressive revenue and subscriber numbers. The U.S. dollar was marginally firmer on Thursday, failing to significantly capitalize on the spike in Treasury yields as well as the flight to safety. The dollar index remains below its October 3rd peak, suggesting that FX markets are adhering to the shift in Fed rhetoric differently than bond markets. Thank you for watching today's Market Comment here at XM.com.